Good evening and welcome to the Money Show, the place where money stops being confusing and starts working for you. That's right, because let's face it, every decision we make, from the coffee we buy in the morning to the home we dream of owning, from planning our next holiday to securing our children's future, has one thing in common: money. Yet, despite the role it plays in every chapter of our lives, very few of us were ever taught how to manage it, grow it, or make smarter financial decisions. That's where we come in. Whether you're just starting your financial journey, building wealth, investing for the future, planning or retirement, or simply trying to make your salary stretch a little further, this is your show. Every day, we'll cut through the jargon and the noise to bring you practical advice, expert insights, smart investment ideas, tax-saving strategies, market trends that actually matter, and real stories from people who've transformed their financial lives. So no complicated spreadsheets, no intimidating financial language, just clear, honest conversation about the decision that can help you build a stronger financial future, because personal finance isn't just about numbers. It's about freedom, it's about choices, it's about peace of mind, and ultimately it's about creating the life that we want. So let's get started. I'm Kavita Thapliyal, and just in case you have just tuned in, want to send across your questions, we'll just quickly flash our email ID and our WhatsApp number where you can send across your portfolio questions, and we will get it answered live on the show. So first up on the show today, following a volatile Q4 FY26, when the Nifty declined 14%, FY27 began on a much stronger note. The Nifty gained nearly 7% during the April-June quarter, while the Nifty Small-Cap Index surged 24% and the Nifty Mid-Cap Index advanced more than 17%. Now, if we look at July so far, private banking heavyweights and IT sector earnings are the primary drivers shaking the Indian share markets in July 2026. Heavy earnings-driven volatility, changing global sentiment, and fluctuating crude oil prices have led to selective stock surges and dramatic sector rotations. But let's make sense of all this for your portfolio. Joining me now is Trideep Bhattacharya of Edelweiss Mutual Fund. Trideep, hi, good evening. Thank you so much for joining in. Always lovely to have you. And a very exciting start of the day, I must say. But, before I go into the specific, we talk about earnings in a market environment, where valuations right now are tightly scrutinized. If we have to talk about specific risk mitigation filters, that one may want to apply, what's going to be your approach within broader market, or overall your approach towards having a risk mitigation strategy looking at the current juncture where the market is?
First of all, Kavita, thanks for having me on your very popular show. Happy to be here. I would say that, being nimble-footed in this environment is actually the way to go about it. The reason I say so, about a fortnight or so ago, we almost came out of the war-like situation. And now oil has climbed up about 10 to 12%. And hence, the macro condition is, again, right in the middle. So two or three opening comments I would make with regards to, first of all, what we think about the market, and then the risk aversion strategy. One is, I think, over the last couple of years, India has had meaningful headwinds. Whether it's India was the anti-AI trade, then the anti-oil trade. I think going forward over the next 12 to 18 months, with the AI trade gradually rolling over, and also oil, barring the immediate move up, is gradually trending downwards. So what was the bane for us might turn out to be a boon over the next 12 to 18 months. However, given that the macro conditions are likely to remain quite volatile, focusing on bottom-up earnings resilience is, in my opinion, the best risk aversion strategy that we do at our end. By focusing on those areas which have business models that have pricing power, that have moat, which can wither through volatile circumstances and still keep earnings intact. That's at our end. From an investor's end, I would say diversification across different market cap and sectors is good.
All right, Trideep, but then let's also focus a bit on large cap funds. You've several times pointed out that large cap funds may be losing their traditional edge due to structural shifts in the market share. Could you specify which dynamic sectors are moving out of the large cap domain and driving you to heavily favor, flexi cap or maybe a mid cap strategy instead?
Sure. So the way to think about this is when we think about stock picking, we don't think market caps. We think about companies that are taking market share in the economic context. So if I pick two big sectors, for instance, financials, or for instance, consumption, in both of these sectors, new age business models like fintech or consumer tech and different ways to different challenger brands are actually taking market share away from the traditional brands or the incumbents. These incumbents are at the moment sitting in the form of large caps and as part of the large cap universe, whereas the challengers are mostly in mid and small cap domain. Which is why I've always been a proponent of the fact that while some large caps are fine, some large caps, others are actually facing a bit of a headwind from newer age business models in the same segment taking market share away. So as an investor, you're far better off having a combination of these in your portfolio and hence the Flexicap strategy.
All right, let's move on and let's talk about the earning part of the market. And you projected a 2 to 4% earnings cut for FY27, if I'm right, on the back of Q1 results. Now, given that the market has already factored in much of this weakness, now, which pockets or sectors are we talking about? Which pockets or sectors do you expect to face the sharpest downgrades, and where do you see the earliest earnings recovery also coming in? And so far, whatever has come out, your take on it?
So I think on net balance, the drivers of the revenue growth have pointed that despite challenging macro conditions, the revenue growth or the volume growth has held intact, even in the month of June. However, just to place a data point, the average crude oil price that the companies are lapping in this particular quarter is about $97, whereas the spot is somewhere around 80 or there or thereabouts. So there's a meaningful delta with regards to where the spot price of oil is and the company the quarter average. And that's why I was saying that on the margins front is where the headwinds lie for the quarter and some part of September quarter. So the biggest margin drop I expect in those sectors which use commodities as an input. So that could be autos, that could be tires. Basically, consumer discretionary as a sector particularly would see a good amount of headwind on margins front, and we saw some tire results come through which reflected that then those headwinds. But when I look at their outlook, the outlook seems to suggest that broadly that's the worst of the margins that we will see in June or September quarter. So that's the good news. But otherwise, the commodities, the headwind in some of the commodity user sectors have caused margin declines anywhere to the tune of 300 to 500 basis points.
One particular point on broader market, given your view that the broader market is hovering near fair value, what major catalysts aside from direct government capex deployment are required to spark the next big wave of earnings upgrades in this particular segment?
So I think, first of all, the full impact of the tax cuts that happened late last year are yet to be factored in. While we saw 2 quarters of that reflecting in auto demand and consumer discretionary demand, and then came the war. So I think some of that tailwind will continue as we come out of a war-like scenario. The next catalyst that I think, particularly on the ahead of festive season, an announcement could be helpful for markets would be basically the pay revision. This pay revision this time around is likely to be quite meaningful, even though it will come at a later date. But when announcement comes through, some bit of factoring in will stand to come through. And as you know, India spends a good bit in festive season. So in the second half of fiscal year 27, that would mean a very good catalyst for bottom-up earnings standpoint as we go towards the second half. But I think from a flow perspective, the rolling over of AI trade is probably another positive catalyst for India as a market.
Let's talk about financial sector. You have expressed a strongly bullish stance on financials. Now, with net interest margins under pressure for several banking heavyweights this quarter, what structural drivers keep you confident in banking over the medium term? And also, your take on the entire private banking sector.
So first, the most important data point for us to internalize is that credit growth in the economy bottomed out at about 8 to 10% last year. It's currently at about 16% and will head towards somewhere between 16 to 20% over the next 6 to 12 months. That is a fairly constructive sectoral backdrop to look at financials, in my opinion, whichever part of financials you look at. Within that, I would say if you include valuations and future NIM outlook, along with asset quality, the private sector banks, particularly the mid-tier private sector banks, scored particularly well because valuations are reasonable. They have reported fairly strong growth rates, and asset quality wise, they are still doing fine despite volatile macro conditions. So all of these make the sector look fairly good, if you ask me, from a 6 to 12-month perspective. Despite some bit of initial rally that we have seen, we think that NIM pressure will actually ease out for private sector banks as we go towards the second half of this year.
So, but Trideep, conversely, you remain underweight on IT. Is that true? And post earnings, we've seen a slight recovery also this month. But what's going to be your view? Do you think the sector is in a transition phase? And what structural roadblocks must global IT services clear before you shift your stance to neutral or overweight in this space?
Absolutely. So I think we are at the moment marginally underweight IT services. We think that tech, AI is another big one, though, tech wave that the Indian IT services sector is facing at the moment. This has two components to it: valuations and earnings. Valuations have reached rock bottoms, which is why we are not materially underweight in this sector. But earnings momentum will take some time to come through. And that's the reason that explains our marginal underweight at this point in time. We think that this is a 4 to 6 quarter phenomenon, of which a couple of quarters have already passed. As the earning momentum starts reshining for the sector over a period of time, we will be inclined towards taking a more positive view, but that's at some point in future, not at the moment. For now, we remain watchful of earnings upgrades stroke downgrades. We noted that in June quarter, on lowered expectations, earnings were just about met the expectations, and that's why we saw a bit of a relief rally come through. We would like to see that through for a couple of quarters more for us to be very confident on the earnings front.
You noted the absolute peak of India's wealth creation window is still a decade away, making regular SIPs far superior to trying to, time volatile market corrections. How should retail investors structure their core asset allocation today to absorb global geopolitical ripples without panicking? I know, very common question, but then we also know the trajectory of the market keeps changing. So what's going to be? I know you will give an evergreen answer, but just put an element of the current situation in it.
I think in the current situation, we are in a fairly fragile geopolitical climate globally. And I don't think in the near future, i.e. 2 to 3 years, it's going to go away. So in these circumstances, it's best to have a geographically diversified portfolio from an investor standpoint. I am more inclined at this point in time towards India as opposed to other emerging markets, because I think our round of underperformance driven by, as we discussed, the anti-AI trade and anti-oil trade. Still, from an asset allocation standpoint, I do think that geographic diversification does really matter, though incrementally, I would put more money into Indian equities than other emerging markets. That's one. Second, I think investors should also have, as part of their asset allocation, some exposure to real assets. Given the fragile geopolitical climate, I think real assets will actually see good days ahead, given that overall inflation will be on the higher side. So as a combination of this, I think investors would do well for themselves over a period of next 3 to 5 years if they follow some of these sort of headlines and then sit with the advisor to calibrate their risk objective with returns and form an asset allocation.
All right, I think with that, it's time up on this particular discussion. But thank you so much, Trideep, for always being there for our viewers and guiding them right for their investment portfolio. Thank you.
Thank you.
All right, with that, we'll slip into a short break. But post that, it's time to answer your portfolio queries. We'll be joined by Shweta Jain, our guest on the show. But before we take a break, let's just quickly flash our WhatsApp number and email ID where you can send across your portfolio questions, and we will sort it out live with our guest for you on the show.